Welcome to the Opening Bell Report.
Okay, picture this. It's Tuesday morning, the sun is shining, coffee's hot, you're feeling pretty good about the week. You pull out your phone, tap your brokerage app for just a quick peek, and then boom.
Total carnage.
A sea of red. But not just the normal, market's down a bit red. You see one of your star players, Applovin ticker APP, down 16%.
16?
In a single day. You check the price, and it's down $74 from the open.
It is the absolute nightmare scenario for an investor. That visceral feeling when the line doesn't just slope down, it falls off a cliff.
Exactly. It's that moment where your stomach just drops and you think, is the dream over?
Yeah.
Did I miss something? Is the company broken?
Yeah.
Frankly, if you looked at the chart during that drop, it looked like a crime scene.
It certainly did. And usually when you see a drop of that magnitude, 16% in one session, it triggers a very specific fight or flight response. The instinct is just to sell, to stop the pain.
Right? Get me out before this thing goes to zero. But today, we are doing something different. We are forcing ourselves to take our hand off that sell button. We're going to look at a specific analysis report titled Applovin, the case for conviction amidst market panic.
And the mission for this deep dive is, well, it's pretty simple. We need to figure out if this crash is a sign to run for the hills, or if this is one of those rare golden opportunities disguised as a disaster.
Which is often where the most interesting insights live, right in the middle of that panic. What we're really unpacking today is a battle between two very different types of market participants. On one side, you've got the momentum traders, the people who ride the wave up and bail the second it crests. And on the other, you have the fundamental investors who are ignoring that red line and looking at the actual engine of the business. So let's unpack this. Because the report we're analyzing argues that the momentum crowd is fleeing the scene, leaving a huge opportunity for everyone else. But before we get to the opportunity part, we have to respect the fear. We have to look at the bad news. We have to understand why the stock shed $74 in one session. That is a lot of value vaporized in 6.5 hours.
It's a significant haircut, and the analysis report, it describes this situation as a cocktail of fear.
Right.
It wasn't just one thing that caused the drop. It was a convergence of several negative narratives hitting the market at the exact same moment.
A cocktail of fear.
Yeah.
I like that image, even if I hate the result of my portfolio. So play bartender for me here. What's actually in this cocktail? Because stocks don't just drop 16% because people woke up in the wrong side of the bed.
No, they don't. The first and probably the most potent ingredient is rumors. Specifically, rumors surrounding Google and something called Project Genie.
Project Genie. That sounds kind of innocuous, like a Disney movie or something. But I'm guessing in this context, it's not very helpful.
Far from it. This is the existential threat narrative. The rumor mill started churning out these stories that Google is working on a new AI-driven gaming capability. The fear is that this new tech could theoretically allow Google to bypass ad tech intermediaries entirely.
Okay, hold on. Let's stop there. Bypassing intermediaries. That means bypassing companies like Applovin.
Exactly. Applovin sits in the middle, helping games find users and monetize. The fear is that if Google, the 800-pound gorilla of the internet, decides to handle that directly with some new AI magic, well, Applovin gets squeezed out.
So the story is, Google is entering the chat, Applovin is dead.
Precisely. It triggers that deep-seated trauma investors have of big tech crushing the little guy. When a giant like Google sneezes, the rest of the tech world catches a cold. So the mere mention of a project that might disrupt gaming, it sends shivers down investor spines.
But is there any real evidence that Project Genie is actually going to kill them? Or is this just a spooky ghost story?
At this stage, it's mostly smoke. But in the stock market, smoke is enough to cause a fire sale. Investors don't wait for the obituary. They sell at the rumor of the illness.
Okay, so that's ingredient one, the big bad wolf. What else is in the mix?
Then you add in the short sellers. The analysis points out that coinciding with this drop, there were what it calls recycled reports circulating about ad quality.
Recycled. So this is old news.
That's the implication. These aren't new bombshell revelations. These are existing concerns about, the quality of ads or user acquisition methods, things that have been talked about before, getting repackaged and amplified right when the market mood turns sour.
That feels incredibly opportunistic. It's like kicking someone when they're already on the ropes.
That is exactly how short selling works. Short sellers thrive on confirmation bias. If people are already nervous about Google, a report questioning ad quality lands much, much harder than it would on a green day. It confirms the fear. See? There's something wrong here.
So we have the Google threat, we have the short sellers piling on. What's the final ingredient?
The final ingredient is just the broader market context. We're seeing a general fear of high valuation stocks. There's talk of a tech rotation.
Rotation? That's Wall Street speak for taking the money and running.
Essentially. It's when money moves out of the high-flying tech winners, the stocks that have gone up 100%, 200%, and moves into safer, more boring sectors like utilities or consumer staples. The flight to safety.
And Applovin has definitely been a high flyer. I mean, you just have to look at the chart over the last year.
Oh, absolutely. We have to contextualize the price here. Even with this drop, we're talking about a stock that hit highs of $745.
$745. And now, what, trading around $387?
Correct. Down over 40% from its peak. That is a massive correction.
So if you bought at the top, you are feeling some serious pain right now. You've lost nearly half your money.
And that pain is what drives the momentum traders out. They see the trend line break, they see the 40% drawdown, and their algorithms or their gut instincts just scream sell. They aren't looking at the balance sheet, they're looking at the chart. And the chart says down.
Okay, so that explains the why. That's why the screen is red. Momentum traders are bailing because the price is dropping, which makes the price drop more, which scares the Google watchers, which invites the short sellers. It's a spiral.
Exactly. It creates a disconnect. And this is where it gets really interesting. The analysis report we're looking at argues that this disconnect, this gap between the crashing stock price and the business reality, is the key to the whole thing.
This brings us to what the report calls the voila moment. I love a good voila moment, but usually in finance, those moments are buried deep in spreadsheets.
This one is hiding in plain sight.
The core argument here is that while the stock price is falling off a cliff, the actual money the company's making is doing something almost unbelievable for a company of its size.
This is where we have to stop looking at that scary red line and just pop the hood to look at the engine. The stat that really jumps off the page is the year-over-year revenue growth.
Okay, hit me with it.
68%.
68%.
68% growth.
Okay, let's pause on that, because when I hear 60% growth, I usually think of a tiny startup that just found its first 10 customers. I don't think of a multi-billion-dollar public company. Usually when companies get this big, gravity kicks in. They slow down, they become big, lumbering giants. But 68%, that is sprinting speed.
It is hypergrowth. And to really understand how absurd that number is, the report makes a very compelling comparison. They put Applovin up against the trade desk.
Okay, the trade desk. Ticker TTD. They're the absolute darling of the ad tech world, right? Everyone loves the trade desk. It's considered the safe, blue-chip ad tech stock.
Correct. It's widely held, very respected, considered the gold standard for independent ad tech. It's a great business. But let's look at the numbers side by side, like the report does. The trade desk is growing revenue at about 18%.
18%. Okay, that's respectable. Solid double digits.
It's perfectly fine, but Applovin is growing at 68%. That's nearly 4 times the growth rate.
Okay, so Applovin is sprinting while the trade desk is jogging. But surely there's a catch. Usually high growth means you're burning cash, right? You're spending $1 to make 80 cents just to grab market share? It's the classic Silicon Valley playbook.
That is the standard rulebook. But Applovin is breaking it, and this is where the comparison gets wild. The trade desk operates with EBITDA margins of around 20%. That's healthy. That's a good business.
Sure, 20% is nothing to sneeze at.
But Applovin, they're posting margins around 50%. 50.
50%. So for every $1 of revenue that comes in the door, they're keeping 50 cents as operating profit. How? That sounds too good to be true. That sounds like software monopoly numbers. How do you maintain 50% margins in competitive ad tech?
It comes down to the business model differences. The trade desk, as great as it is, it relies heavily on relationships, on sales teams, on human capital to help brands buy ads. It's a service-heavy model. Applovin's engine, which we'll get to, is almost entirely automated software. It scales without adding headcount. They don't need to hire 1,000 salespeople to sell the next $1 billion of ads. The code does it.
So it's a money printer.
Effectively, yes. So you have Applovin growing 3 to 4 times faster than the safe alternative, with more than double the margins. But here is the voila moment. The market is pricing them at nearly the same price-to-earnings multiple.
Wait, really?
Yes. Applovin is trading at a PE of around 47. The trade desk trades anywhere from 42 to 60 times earnings, depending on the day.
So let me get this straight. I can buy the company growing at 18% for roughly the same price in terms of valuation as the company growing at 68% with way better margins.
That is the disparity the report is highlighting. It makes absolutely no sense if you just look at the fundamentals. If you were buying a private business and you saw those 2 sets of books, one growing at 18% with 20% margins, and one growing at 68% with 50% margins, and they cost the same, which one do you buy?
You buy Applovin every day of the week and twice on Sundays.
Exactly. But in the public market, the sentiment around safety versus risk distorts the price. The market is treating Applovin like a speculative, risky bet because of the Google rumors and treating the trade desk like a sure thing, completely ignoring the actual cash hitting the bank account.
And that brings us to the concept of free cash flow.
My favorite 3 words in finance.
It should be. But let's define it for everyone. We're not talking about adjusted EBITDA or some other made-up metric. We're talking about cash.
Right. Free cash flow is the cash left over after the company pays for its operations and capital expenditures. It's the money they can put in the bank, use to buy back stock, or acquire other companies. The report emphasizes that Applovin is not a speculative, profitless tech stock. It describes it as a cash-generating machine.
So effectively, a 40% drop in stock price for a company like this becomes a math problem, not a solvency problem. They are not going to run out of money.
Far from it. They're fully funding their own growth. They aren't diluting shareholders to raise money. They are printing cash.
Okay, so the numbers are incredible, but I have to play devil's advocate here. Numbers like that, 68% growth at 50% margins, don't just happen by magic, especially in 2026. What is the secret sauce here? Because if the answer is magic, I'm not buying it.
The report identifies a secret weapon, and I know you're going to roll your eyes when I say this because it's the buzzword of the decade, but in this case, it seems to actually be working AI, specifically something called AXON 2.0.
AXON 2.0. Okay, stop. I have to push back here. In 2026, if I hear AI engine one more time, I might scream. My toaster claims to have an AI engine. My electric toothbrush has an AI mode. Is this just a buzzword they threw into the investor deck to stop the stock from falling? Or is there actually something there?
I completely get that skepticism. It is the buzzword of the era. But the report argues this isn't PowerPoint AI. This is cash register AI.
What does that mean, cash register AI?
Think of it this way. Most ad companies use what we call probabilistic data. They guess who you are. Oh, he visited a car site last week. Maybe he wants to buy Ford. It's fuzzy. It's like throwing spaghetti at the wall.
Right, which is why I get ads for cat food even though I own a dog. The algorithm is guessing.
Exactly. AXON 2.0 isn't guessing. Because Applovin sits inside the mobile gaming ecosystem, they have massive amounts of performance data. They know exactly who plays, how long they play, and most importantly, when they click and when they buy. AXON uses a neural network to match ads with a precision that feels almost telepathic.
So it's not just throwing spaghetti at the wall.
It's a sniper rifle.
And that precision translates to money.
Directly. That's the monetization versus hype distinction the report makes. While other companies are releasing press releases about what they plan to do with AI in 5 years, Applovin is using AXON 2.0 right now to target ads. And because the targeting is so effective, advertisers see a massive return on their ad spend.
And if the advertisers make more money using Applovin,
they spend more money with Applovin. The report argues that for mobile game developers, the results are so good that they literally cannot afford not to use it.
there it is. There's the moat. That's the defensive wall.
Yes, if you're a mobile game developer and you need users to survive, you go where the results are. If AXON 2.0 gives you better users for cheaper than Google or Unity, you spend your money with Applovin. It doesn't matter if you like Google better, you have a business to run.
And that kind of answers the Project Genie fear, doesn't it? Even if Google launches a new tool, they have to beat the efficiency of AXON 2.0, which has years of historical data and is getting smarter every single day.
Correct. The data advantage is real. The more transactions AXON processes, the smarter it gets. It's a flywheel. And the report suggests this is why the margins are so high. The software does the heavy lifting. They don't need a massive sales force because the results sell themselves.
It's fascinating because it flips the narrative completely. The market is scared of AI disruption. Oh no, Google's going to use AI to crush them. But the report is saying, no, Applovin is the one winning because of AI.
That's the contrarian stance. The market sees AI as a threat to Applovin. The fundamentals show AI is their superpower.
So we've got the panic in the market, we've got the insane growth numbers, and we've got the AI engine driving it. Now we have to talk about the verdict, where the rubber meets the road. The report says the stock is transitioning. What does that mean?
It suggests a shift in identity. The stock is moving from being a momentum high flyer where people buy it just because it's going up to a value growth stock.
Value growth. That sounds like an oxymoron. Usually you get value, which is cheap, or growth, which is expensive.
It does sound contradictory, but it's the investing sweet spot. It means you are getting high growth, but you're paying a value price for it because the market is scared. The analysis argues that at $380, which is roughly where we are, you are paying a very reasonable price for nearly 70% growth.
It's like finding a designer dress at a thrift store price because someone spilled a little water on it.
If the dress was also printing money, yes.
Right. But let's talk about the risk. I don't want to paint too rosy a picture here. The report doesn't shy away from the fact that this is volatile.
No, and that is crucial for listeners to understand. Do not mortgage your house for this. The report explicitly warns risk, high volatility. This stock can swing 10% in a day. We just saw it drop 16%. It acts like a coiled spring.
So if you buy this, you have to be prepared to see it drop another 10% tomorrow. You have to be able to stomach the swings without panic selling.
Absolutely. Volatility is the price of admission for these kinds of returns. But the case for conviction argues that if you believe in the thesis, if you believe in the AI ad tech dominance, then selling here is pure emotional panic, and buying here is conviction.
I noticed the report mentioned a specific buy zone, a number where the analyst really pounds the table.
Yes, they mentioned the $350 mark.
350.
The report calls that the load the truck zone.
Load the truck. I love that imagery. That's not nibble. That's back the dump truck up and fill it.
It implies maximum confidence. The analyst is saying, I'm not selling a single share. In fact, if it hits 350, I'm buying as much as I can because the valuation becomes undeniable.
That is a bold call when everyone else is running for the exits.
It is. But historically, the best returns are made when you buy from people who are selling out of fear, not out of logic. As the saying goes, buy when there is blood in the streets.
So, to summarize where we are, the headlines say blood in the streets. The chart says disaster, but the report says opportunity.
That's the gist. You have a massive disconnect. The market is screaming tech rotation and competition, but the company is screaming 68% growth and 50% margins.
It really forces you to check your own psychology. Like, are you reacting to the red color on your screen, or are you reacting to the business performance?
And that is the hardest discipline in investing. To look at a stock that's down 40% and say, the business is actually better today than it was when the stock was at $700. Because at $700, the expectations were sky high. At $380, the bar is much lower, but the performance is the same.
It's a reality check. You know, we spend so much time in these deep dives trying to find the nuance, but sometimes it just comes down to the cash.
Indeed. You can argue about sentiment, you can argue about rumors, you can argue about what Google might do, but you can't argue with free cash flow. It's hard to argue with cash in the bank.
So as we wrap up this deep dive, we're left with a pretty clear picture. A company that has been battered by the market, cut almost in half, yet is posting numbers that would make most CEOs weep with joy.
A classic setup for either a massive rebound or a value trap, if the market knows something we don't. But the data in this report heavily favors the rebound thesis.
It definitely makes you think twice about hitting that sell button just because the line is red.
Or perhaps makes you think about hitting the buy button.
Careful now, we're just analyzing the report.
Of course, just analyzing.
But it does leave us with a really interesting thought to chew on. We spend so much time obsessing over AI narratives. Who has the best chatbot? Who has the coolest demo video? But here's a question for you to consider. In a market obsessed with AI stories, is the biggest risk actually ignoring the companies that are quietly using AI to print cash, simply because their stock chart looks scary today?
That is the multi-billion-dollar question. Are you watching the show or are you watching the business?
Something to think about next time you see a sea of red in your portfolio. That's it for this deep dive into Applovin. Thanks for listening.
Until next time.
See ya.
Don't forget to like, share, and subscribe for more.